Partnerships. A partnership is formed to overcome the disadvantages of a sole trader. A partnership enjoys the advantages of multiple ownership. Normally, there can be a minimum of 2 partners and a maximum of 20. The advantages of this form of business structure are: A. More capital is available to the business. B. The new partner or partners will have skills that will be beneficial to the business, and this can increase its customer base. For example, a solicitor who perhaps was an expert in civil law now acquires a partner who is an expert in criminal law. C. The management of the firm is shared, and this makes the firm more efficient in that there are more ideas, and the burden of running the firm does not rest on the shoulders of just one person, as in a sole tradership. D. Losses can be shared. The disadvantages are: A. Profits will be shared in the partnership. B. Decision-making may take longer, as both partners or all partners will need to agree. C. There is a risk of disagreement or conflict between partners. D. Each partner's actions are binding on all partners. And E. The control of the business by each partner may be difficult. A partnership deed or agreement. A partnership deed is also known as a partnership agreement. It is a written agreement drawn up in order to avoid future disagreements. Though it is not a legal requirement, it eliminates problems between partners. The usual accounting contents are: A. The amount of capital to be invested in the business by each partner. B. The rate of interest, if any, to be paid on capital. Interest on capital is paid if the work done by each partner is of equal value, but the capital contributed is unequal. Interest is a form of compensation to the partners concerned for the money they have invested in the business that they could have invested elsewhere. C. The ratio in which profits or losses are to be shared between the partners. D. The rate of interest, if any, to be charged on partners' drawings. Interest is charged on drawings as a penalty to deter partners from making excessive drawings. E. If a salary is to be paid to any of the partners, and if so, the amount. Salary is paid to partners as a reward for taking on more responsibility compared to other partners, or for doing more tasks. F. The rate of interest, if any, to be paid on partners' loans. It must be remembered that a loan is not to be regarded as capital, and a separate loan account is to be opened. The interest on such a loan is treated as an expense with any other loan interest in the income statement. G. The upper limit, if any, to be placed on partners' drawings. It is evident that a business benefits if it has good liquidity to finance expansion or to take advantage of bargains or cash discounts given by suppliers for prompt payments of debts. Hence, if drawings were restricted, the firm would benefit from the additional liquidity. H. Arrangements for the admission of new partners. What happens when the partnership has not made or drawn up a partnership deed. In the UK, where no partnership deed exists, the Partnership Act of 1890 governs the situation. The Act states: A. Profits and losses should be shared equally. B. No interest on capital is to be charged. C. No interest on drawings is to be charged. D. There are to be no salaries paid to partners. E. A rate of 5% per annum is given to partners who contribute a sum of money to the firm in excess of the capital he or she has agreed to subscribe. In this slide, we will be examining the difference between fixed capital and fluctuating capital accounts. Fixed capital accounts. When the capital account of each partner remains at the figure of capital contributed by the partner year after year and does not change due to profits or interest earned or drawings made, for example, then such an account is called a fixed capital account. A current account is required to be maintained in addition to a fixed capital account. Profits and losses, drawings and interest are recorded in this current account. Fluctuating capital accounts. If the capital account is used to record drawings, interest, and profits or losses in addition to the capital contributed, the account is a fluctuating capital account. The balance on these capital accounts will then change year after year. Note: fixed capital accounts are preferred by partnerships. This is due to the fact that when partners withdraw money from the firm more than they have earned by way of profits, salary, or interest, then they will have a debit balance on their current accounts, and this can act as a warning. The Profit and Loss Appropriation Account. The appropriation account shows how the profit for the year is shared out between partners. This is an example adapted from a past paper. Pause the video to study the information given very carefully. The income statement, the appropriation account, and current accounts are on the next slide. Here is the solution to the example in the last slide that was adapted from a past paper. Sherry and Harry's income statement for the year ended 30th June 2017. The gross profit is $40,960 as per the information given. In additional information, you were told that inventory was overvalued by $380. We will deduct this to get a revised gross profit of $40,580. Less operating expenses. Let us look at working one. $28,390 as per information given, minus prepayment for 2 months, July and August, which works out to 2/3 of $3,450 to give us operating expenses $26,090. Depreciation. Using the reducing balance method, 20% of $64,000 cost minus $22,000 accumulated depreciation to give us depreciation for the year $8,400. Interest on loan, 8% of $8,000 to give us $640. Deducting the expenses, we get profit for the year $5,450. Let us now draw up Sherry and Harry's appropriation account for the year ended 30th June 2017. Profit for the year, as just calculated, $5,450. Add interest on drawings as per information given. Sherry $310, Harry $240. Less interest on capital as per working 1. Interest on capital, Sherry's capital, 10% of 42,000 works out to 4,200. Interest on Harry's capital, 10% of 28,000 works out to 2,800. On deducting this, we get a loss of $1,000, which is shared as per working 2. The loss is shared in the ratio of the balance on the capital accounts, 42,000 Sherry, 28,000 Harry. That works out to 3:2. Therefore, Sherry's share is 3/5 of $1,000 to give us $600. Harry's share of the loss is 2/5 of $1,000 to give us $400. Let us now look at the current accounts. On the debit side, Harry has a debit balance on his current account of $2,430 as per the information given. Drawings, Sherry $18,300, Harry $16,820 as per information given. Interest on drawings, Sherry $310, Harry $240 as per information given. Residual loss shared, Sherry $600, Harry $400. Let us look at the credit side. Sherry had an opening balance in her current account of $1,470. She also earns interest on loan of $640. Interest on capital, $4,200 Sherry, $2,800 Harry, as worked out in the previous working. Therefore, the balances carried down are Sherry $12,900, Harry $17,090. Let us look at the financial statements of a partnership. Michelle and Jane are partners in a business that they started on the 1st of Jan 20X5. On that date, Michelle introduced $20,000 cash as capital and Jane contributed $35,000. On the 1st of July 20X5, that is midway during the financial year, Michelle lent $10,000 to the business. The partnership's trial balance at 31st December 20X5 is given to you. Study the information given carefully. Let us look at further information number 3. The partners had not drawn up a partnership deed regarding interest on capital and drawings, salaries, or sharing of profits. Note, as there is no partnership deed, the clauses of the Partnership Act will kick in. Let us now draw up Michelle and Jane's income statement for the year ended 31st December 20X5. Sales revenue $14,000, less cost of sales. Purchases $7,000, less closing inventory $1,400 to give us a gross profit of $8,400. Less expenses, rent $1,000, sundry expenses $800, staff wages $5,000. Interest on partners' loan at 5% according to the Partnership Act would be half of 5% times $10,000 to give us $500. Depreciation, as per further information 2, is 5% of $25,000 to give us $1,250. On deducting this, we have a net loss of $150, which is shared by Michelle and Jane equally as per the Partnership Act. Remember, there is no partnership deed. Let us now look at the current accounts. There is no balance brought down as this is a new partnership. Let us look at the debit side. Drawings as per information given, $7,800 Michelle, $5,600 Jane. Share of loss, $75 Michelle, $75 Jane. Therefore, the balances carried down are $7,875 Michelle, $5,675 Jane. Let us now draw up Michelle and Jane's Statement of Financial Position for the year ended 31st December 20X5. Assets. Non-current assets. Premises. Cost $25,000 less depreciation $1,250 to give us a net book value of $23,750. Current assets. Closing inventory $1,400 as per further information. Trade receivables $12,000. Bank $21,500 to give us total assets of $58,650. Capital and liabilities. Capital accounts. Michelle $20,000, Jane $35,000. Current accounts. Michelle $7,875, Jane $5,675. They are both negative as they are debit balances as per the current accounts we have just drawn up. Non-current liabilities, loan from Michelle $10,000. Current liabilities, trade payables $6,700. Interest accrued $500, which is the interest on Michelle's loan, to give us a total capital and liabilities of $58,650. Note: always draw up the current accounts before drawing up a statement of financial position for partnerships in order to work out the closing balances on partners' current accounts. More information about AS Accounting, a study guide. The content of this book matches the latest CRE AS syllabus and is pitched at a level that is extremely workable. The book is written by a qualified and experienced teacher and fills the need for a guide that is solely meant for the CRE AS Accounting course. Some salient features of the book are: it unpacks the CRE AS Accounting syllabus. IAS terminology has been used. Students love the unique question and answer presentation of theory. There are numerous tips for success and exhaustive exercises for practice. This book is available at most book outlets worldwide, including Book Depository and Amazon. They are available in hard copy as well as in e-book format. Here are other titles available: AS Accounting Workbook, a write-in workbook that will help you prepare for your examinations, and Revising A-Level Accounting. Please contact me at junebaptista@hotmail.com for more information and for answers.